Hello everyone and welcome to Investing Angles. Today we are talking about TLT and the bond market. Last week TLT closed the week with potentially bullish candles and registered a couple of bullish signals. Today we are going to evaluate whether these are changes in the long-term perspective or it's just a short-term bounce. Later in this presentation, we will discuss the bond market, particularly yields for 10-year and the other ones. And also, we will discuss some development in spread, 10-year minus 2-year. All right, so let's get started. Before we start, please subscribe to our channel. Check our website investingangles.com. And let's begin. So this is the candle map for TLT after the Friday's closure. So what we are seeing here, first of all, the weekly closure. It is a fairly strong bullish engulfing, and the chances for the next week to be green are fairly high. However, speaking from the technical perspective, this candle doesn't have a lot of support, and we would need for a bigger trend to be established, we would need to have a strong confirmation at the end of next week. Speaking about smaller trends, this is the 5-day frame, five-day candle closed on Thursday, and it also a piercing line, which is a bullish candle. So technically we have 5-day and weekly candles are aligning for a bullish move. Speaking about the daily, daily potentially formed the bottom here on the daily frame, and it managed to move above 8 EMA support level right now. So the candle, the red candle, it could be an in-neck candle, but also could be a reversal candle, depending on the Monday's closure. So far, we are looking for potentially bullish stance and the chances to continue advance. So far, this is we'll consider it neutral until we see a confirmation on Monday. And just a reminder, this is the monthly frame. Monthly frame closed with a strong bearish candle, and I'd like to emphasize this particular cross. This is a death cross, 50 over 200 months moving average, which is quite rare. It happened only twice. And the chances for continued move down are fairly high. And well, the next candle will be formed only at the end of January, and we will see what candle it will be. Now let's move on to the Elliott waves. So what we are seeing here, this is a short-term frame, 1 hour. What we are seeing here is the potential impulse of the bottom. It's like I marked here 1, 2, 3, 4, 5. There are a couple of concerns about developing this impulse. First of all, it's wave 1, which is not clearly impulsive, but I cannot say it's for sure corrective. So that's a big question right now, and we would only know it after a big formation is established. So far, this wave 3, well, it could be an impulse, and if TLT manages to hold this 85-84 level and establish another impulsive wave up, then we would consider this a first impulse of the bottom, and it will be a continuation in the same direction after a consolidation phase. If, however, the TLT breaks through 85, 84, then it will likely invalidate the potential impulse, and it would be somewhat an ABC structure, and I would be considering a bigger correction here. at best. But we will see how it moves on Monday, Tuesday. So these 2 days will be clearly important for forming a structure here. Okay, so let's move on. This is an interesting chart. So I tried to model TLT on a bigger frame, but it wasn't available technically because there was no TLT in 100 years ago. And what I've done, I used US 10-year yield data, and I used inverted scale. So technically, to the best of approximation to the TLT from the long-term perspective. So what we are seeing here is a similar technical structure, the similar technical footprint. You can see this moving averages. This is monthly moving averages. 50 months, it's a blue line. Purple is 100 months, and the red is 200 months. So what we are seeing here is bearish crosses technically, and this is very well aligned with what I showed you here on this chart. So we have a very similar position, very similar stance. And another thing that kind of concerns here is that the structure, I switched to a 3 months frame just to be more specific, and it's better presentation with the candles. So what we are seeing here, that the wave down was rather impulsive, starting with 1941 and ending 1981 for 40 years, and the wave up was corrective, or at best it was motive wave, and possibly a diagonal, because there is absolutely no clear motive or impulsive wave here. And what we know from the perspective of Elliott waves, that the diagonals, or some call it wedges, they tend to return to the level of origin, which is 1585. Oh, it looks like very big and scary number at this moment. But what I'd like to emphasize here, that the structure of the wave down here that started in January 2020 is clearly impulsive. We can see a first impulse, fairly clean, 1, 2, 3, 4, 5, and we consider this just as a wave A or wave 1 of a bigger structure. So this could end up being 1, 2, 3, 4, 5, something like this, or it could be an ABC. So far, looking from the perspective of candles, the last quarterly frame, the last quarterly candle it's shown here, it was very bullish, and so technically it can go higher here. But well, we'll see what would be the closure in January. So far, this is the perspective, and well, that's what we are looking for. Let's move on. This is the 10-year yield, and this is the candle structure right now. So what we are seeing here is that the weekly frame and 3-day frame closed with bearish candles, potentially bearish engulfings, and if they are confirmed next week, we might see a bigger pullback. However, I'd like to emphasize that this daily frame doesn't look very bearish at the moment, so it looks like a ladder bottom or some other bullish formation. So if there is a chance that this Harami candle here, bullish Harami, can reverse the trend and move it higher. And this is the monthly chart. We had a 100 by 200 months moving average golden cross in December 24, and it is expanding right now. So I'm not seeing anything that would reverse it really hard. All right, so let's move on to the next one. This is the chart of all yields. And as I shown you before, this looks like from the candle perspective, all of them are kind of wrapping up this pullback that started in the middle of the week, and the chances for a move higher here are fairly strong. And if we look at the 2-year yield, it it formed a very strong bullish candle. It's an inside up, and the chances for a continued rally here are fairly high. Similar for 5-year, so it's a big bullish harami. And from that perspective, I'd like to move to the next chart. This is a annual chart for 10-year yield, and we discussed last week that what it did. It crossed the 100-year moving average. It touched and crossed, and now it's pulled back a little bit, rejected. However, it's not clear what would be the next move. So if I judge from the other candles and from the other frames, I would say that this pullback is just temporary, and there is a chance that a very high chance that yields will go and surpass this 100-year moving average, establishing a very long trend, a long bullish trend. And to moving to the next chart is this is a spread. This is a spread. I looked at the spread 10 minus 2-year and tried to analyze it from Elliott wave perspective. So what is happening here generally, that the very first wave of the bottom is not clearly corrective. So I circled here the wave, potentially wave 3, which is not corrective at all, or not impulsive at all. So technically I cannot mark this wave as wave 1 of the bottom, so I'm considering it as a corrective wave. And if we have this correction, so it's an A, B, C. And an interesting point here that these 5 waves from the bottom in December 2023, they are not impulsive either, and especially it clearly we can see on wave 1 and the circled here wave 3. So they are not impulses at all. So wave 5 is somewhat, well, it's somewhat unclear. But again, so we have wave 1 and 3 corrective, so maybe we can assume that this wave is also corrective. So in this, if this assumption is right, so it means that we are looking at a impulse at an ending diagonal for wave C here, and I'd like to emphasize that wave C is almost ideally aligned, so it's almost the same size of wave A here. And if this diagonal is confirmed technically, I would say another few moves down and below this wave 3, below the top of wave 3, well, we would be expecting it moving towards minus 0.54 or something. This is the origin of the diagonal, and obviously it will be a negative spread again somewhere later, sometime later this year. And if we look at it, this government chart, Federal Reserve Bank chart. So what we are seeing, this is a spread 10 minus 2-year 2. What we can have another move here down, and it would be somewhat similar to either 2007 when we have a double move here, or 2000 when we had a double move, with the first move and then the second one, or even more for the year 1979, 1980, when we had like multiple moves below zero. Well, that's the perspective, and I would say that from Elliott wave perspective, the negative yield, negative spreads are coming in a couple of months, I would say. And to end up this discussion, this is another candle frame. So this is IEF, which is a counterpart for TLT, only on the shorter term. And we are also seeing this is a bullish formation on the weekly, however, not so strong bullish formations on the daily. So technically, it tells us that we might see a pullback at the beginning of the next week, and then the rally by the end of this by the end of next week. So overall, what we are seeing that TLT is this bearish stance on the short and mid-term frames this week by forming bullish candles and increasing the likelihood of a continued advance. However, given the firmly bearish long-term outlook, this upward move is likely to be limited and potentially lasting one or a few weeks. The monthly and larger frames remain deeply bearish with strong technical indicators reinforcing this perspective. From an Elliott wave standpoint, TLT appears to be attempting to form an impulse at the micro level. And if this is successful, this could support a continued rally. However, if the impulse fails, resumption of a downward trend should be expected. Overall, TLT technical patterns continue to move inversely to the trends highlighted in the US 10-year yield analysis and confirming a consistent macro relationship. The long-term outlook for TLT remains bearish. Thanks very much for watching. Have a wonderful day and happy trading.